If you're watching this video, you're probably trying to figure out where you stand in the economic hierarchy. Are you doing well? Are you falling behind? Should you be satisfied or concerned? These questions matter, but not for the reasons most people think. The real question isn't whether you're in the top 10% or the top 1%. The real question is whether you understand the mathematical principles that separate those who build lasting wealth from those who simply earn high incomes and watch it evaporate. Let's start with income because that's what most people focus on. According to recent data, if your household earns approximately $75,000 per year, you're right at the median. Half of American households earn less, half earn more. This is your baseline. Now, to reach the top 50%, you need very little additional income. But here's where the power law reveals itself. To move from the median to the top 10% requires household income of around $173,000. That's more than double the median. To reach the top 5%, you need approximately $250,000. And the top 1%, you're looking at roughly $570,000 in annual household income. Notice the acceleration. Moving from the 50th percentile to the 90th percentile requires adding roughly $98,000, but moving from the 90th to the 99th percentile requires adding nearly $400,000. This is the power law in action. The distance between percentiles expands exponentially as you move toward the tail of the distribution. Most people see these numbers and immediately start calculating. They think, if I can just get that promotion, if I can just increase my income by this amount, I'll be secure. I'll be rich. This is the first fatal error. Income is not wealth. Income is a flow variable. Wealth is a stock variable. Confusing the two is like confusing velocity with position. They're related through calculus, but they're fundamentally different measurements. Net worth tells a completely different story. The median household net worth in America is approximately $142,000. To reach the top 50%, you need slightly more than this. But to enter the top 10% by net worth, you need approximately $1.3 million. Top 5%, $2.6 million. Top 1%, roughly $11 million. Quick interruption. I create videos in coffee shops with a laptop and way too much coffee. If you'd like to support my work and help keep the content coming, you can buy me a coffee. Link is in the description. Thank you. A household in the top 10% by income might earn $173,000 per year, but they might have a net worth far below $1.3 million. In fact, this describes millions of American households. They have high incomes and relatively low wealth. They've optimized for the wrong variable. I learned early in my career that optimization is everything, but you must optimize for the right objective function. When I transitioned from mathematics to finance, I didn't ask how to make the most money each year. I asked how to generate the highest risk-adjusted returns over multiple decades. That question led to entirely different strategies. Similarly, if you optimize for income instead of wealth accumulation, you'll make systematically different decisions, and most of those decisions will be wrong. Let me give you an example that illustrates this principle. Imagine two individuals, both highly intelligent, both starting their careers at age 25. Person A becomes a corporate lawyer at a prestigious firm. By age 35, they're earning $400,000 per year. Person B becomes a software engineer, earning $150,000 per year. Conventional wisdom says person A is winning. They're in a higher income percentile, they have more social status, they can afford more expensive consumption. But let's examine the mathematics. Person A lives in a high-cost urban area because that's where the law firm is located. Their rent or mortgage consumes $70,000 per year. They spend $50,000 on lifestyle expenses that match their peer group restaurants, clothing, travel, entertainment. They're paying 40% marginal tax rates on much of their income. After taxes and expenses, they're saving perhaps $75,000 per year, which they invest conservatively because they're too busy to learn about markets. Person B lives in a lower cost area. Their housing costs $40,000. They spend $30,000 on lifestyle because they're not trying to match high-earning peers. Their effective tax rate is lower. They save $90,000 per year and invested in low-cost index funds because they understand that active management rarely beats the market after fees. More importantly, Person B structures their compensation to include equity, not just salary, because they understand that wealth compounds faster through ownership than through wages. Fast forward 20 years, Person A has accumulated perhaps $2.5 million. They're in the top 5% by income and probably the top 10% by net worth. They feel successful, but they're not financially independent. They still need their job, their lifestyle requires their income. Person B, meanwhile, has accumulated $4 million, not because they earn more, but because they optimize for wealth accumulation rather than income maximization. The delta compounds over decades. This is not speculation. This is mathematics. The compound annual growth rate of wealth is determined by your savings rate multiplied by your investment return, minus the rate at which you increase your consumption. Most high-income individuals have negative values for this third term. As their income rises, their consumption rises faster. They're running on a treadmill, and the treadmill is accelerating. The second fatal error people make is failing to understand concentration versus diversification across time. When you're young, your human capital is your largest asset. It's the present value of all your future earnings. For most people, this is worth millions of dollars. But here's the critical insight. Your human capital is already a concentrated bet on a specific sector, skill set, and economic environment. If you're a lawyer, your human capital is concentrated in legal services. If you're a tech worker, it's concentrated in technology. Rational portfolio construction requires that you diversify against your human capital, not double down on it. Yet I see brilliant people making the opposite choice constantly. The lawyer invests heavily in real estate because real estate always goes up. The tech worker loads up on their company's stock options without hedging. The consultant starts a side business in consulting. They're adding correlation to their existing risk exposure. I built Renaissance on the principle of finding uncorrelated return streams. We didn't just want positive expected returns. We wanted returns that didn't move together so that the volatility of the portfolio was lower than the volatility of individual positions. This principle applies to personal wealth with even more force because you can't diversify your human capital the way you can diversify financial capital. If you're in the top 10% by income, earning $173,000, and you invest heavily in the same sector that generates your income, you're making a massive uncompensated risk bet. When that sector contracts, you'll face simultaneous hits to both your income and your investment portfolio. This is how people in the top income brackets end up financially fragile despite high earnings. Let me tell you about a pattern I observed over decades. In every market cycle, there's a cohort of high-income professionals who believe their income is permanent. Investment bankers during the credit boom, tech workers during the dot-com era and again in the 2010s, energy executives during oil price spikes. They extrapolate their current income indefinitely. They increase their fixed costs, the mortgage, the private schools, the luxury car leases, and then the cycle turns. Their income drops by 30 or 50%. But their fixed costs don't drop. They're forced to liquidate investments at the worst possible time, often at the bottom of the market, precisely because they optimize for income instead of wealth. The mathematics of financial fragility is straightforward. Your fragility is inversely proportional to the ratio of liquid net worth to fixed annual expenses. If you have $1 million in liquid investments and $100,000 in fixed expenses, you have 10 years of runway. You can survive a prolonged downturn without forced asset sales. If you have $500,000 in liquid investments and $200,000 in fixed expenses, you have 2.5 years. You're fragile. Any significant income disruption forces immediate value-destroying decisions. Here's the paradox. People in higher income brackets often have lower runway ratios than people in lower brackets. The person earning $80,000 with $40,000 in fixed costs and $300,000 saved has 7.5 years of runway. The person earning $300,000 with 200,000 in fixed costs and 800,000 saved has only 4 years. The higher earner feels richer and is actually more fragile. This is why net worth by percentile is a better indicator of financial security than income by percentile. The third fatal error is misunderstanding the relationship between time and compounding. Wealth accumulation is an exponential process, not a linear one. Early in your career, your absolute wealth grows slowly, even if your percentage growth rate is high, because you're compounding from a small base. Late in your career, the absolute numbers become enormous, even if your percentage growth rate slows, because you're compounding from a large base. Most people have this exactly backwards. Early in their careers, when they have the most runway for compounding, they spend nearly everything they earn. They think, I'll save more when I earn more. But when they start earning more, their reference group changes. They're now comparing themselves to other high earners. Their consumption rises to match. They're stuck in what I call the comparison trap, and it destroys wealth accumulation. Let me show you the mathematics. If you save $10,000 per year starting at age 25 and invest at 8% annual returns, you'll have approximately $2.3 million at age 65. If you wait until age 35 to start saving, but save $20,000 per year, you'll have approximately $1.9 million at age 65. You're saving twice as much annually, but you end up with less wealth because you lost 10 years of compounding. Time is your greatest asset when you're young, and most people squander it. Now, let's discuss what being in the top 1% actually means, because this is where the mathematics becomes most interesting. To reach the top 1% by income, you need approximately $570,000 in household income. To reach the top 1% by net worth, you need approximately $11 million. These are vastly different achievements. Income at this level typically comes from one of several sources: senior corporate executives, successful professionals like surgeons or specialized attorneys, business owners, or investment managers. What's critical to understand is that these income levels are inherently unstable. Executive compensation is tied to company performance and subject to sudden termination. Professional income is tied to sustained effort and cognitive capacity. You stop working, the income stops. Business income is tied to market conditions and competitive dynamics. Very few people can sustain top 1% income for decades. Wealth at the top 1% level, however, can be stable if properly managed. $11 million invested at 4% real returns generates $440,000 in annual income. And that's perpetual. You can spend it forever without touching principal. This is the difference between being rich and being wealthy. Rich is a flow. Wealthy is a stock. Rich can disappear overnight. Wealth, if properly structured, compounds forever. I've met countless people over the years who reached the top 1% by income temporarily, during market booms, during career peaks, during successful business cycles. Very few of them converted that temporary high income into permanent wealth. They made the mistakes I've outlined. They increased consumption to match income. They concentrated risk. They failed to account for mean reversion. When their income reverted to more typical levels, they were forced to dramatically downsize their lives, often with devastating psychological consequences. The people who successfully converted high income into lasting wealth shared common characteristics. They maintained stable consumption even as income rose. They understood that income percentiles fluctuate, but net worth percentiles are stickier. They optimized for risk-adjusted returns over long periods, not short-term gains. They thought probabilistically about career risk, market risk, and longevity risk. In other words, they thought like quantitative investors, even if they weren't in finance. Let me address a question that's probably occurring to you. What about the ultra-wealthy, the 0.1% or 0.01%? These groups operate under entirely different mathematics. At these levels, wealth is generated primarily through ownership of productive assets, businesses, real estate, intellectual property, not through labor income. The path to this level of wealth almost always involves concentrated bets that paid off, followed by gradual diversification. I took a concentrated bet when I left academia to start a hedge fund. That was a risk. It could have failed. But the expected value was positive because I had genuine insight into market microstructure that others didn't have. When it succeeded, I diversified gradually, reducing idiosyncratic risk while maintaining exposure to sources of systematic return. This is the rational path. Concentrate to build wealth, diversify to preserve it. But here's what most people miss. You can't reach the 0.1% through salary alone, even at very high salaries. The mathematics don't work. Even at $1 million per year after taxes and reasonable consumption, you might save $400,000 annually. To reach $50 million in net worth purely from savings would take decades. The ultra-wealthy reach their position through ownership, not wages. They either built businesses, invested in businesses early, or generated exceptional investment returns on accumulated capital. This has profound implications for anyone aspiring to significant wealth. You must eventually transition from earning wages to owning assets that generate returns independent of your labor. This might mean starting a business. It might mean investing in private companies. It might mean building intellectual property. But it cannot mean simply climbing the corporate ladder. No matter how high you climb, the top of the corporate ladder might get you into the top 5% or even top 1% by income. It will rarely get you to the 0.1% by wealth. Now, let me connect this to a broader principle about understanding your position in distributions. Most people compare themselves to their immediate social circle. If everyone, earns between $80,000 and $120,000, and you earn $150,000, you feel successful. You're above your reference group. But you might still be in the 60th or 70th percentile nationally. Your frame of reference is distorting your understanding of your actual position. Conversely, if you live in a wealthy enclave where everyone earns $300,000 to $500,000 and you earn $250,000, you might feel like you're struggling even though you're in the top 5% nationally. This is why understanding actual percentiles matters. It recalibrates your reference frame. It shows you where you actually stand in the distribution, not where you stand relative to your non-representative sample. I've always believed that clear thinking requires accurate data. You cannot make optimal decisions based on distorted information. If your perception of your economic position is wrong because you're comparing yourself to an unrepresentative sample, you'll make suboptimal consumption and investment decisions. You'll either spend too much because you feel behind, or you'll become complacent because you feel ahead, when the opposite is true. Let's discuss taxes, because they fundamentally alter the relationship between income and wealth accumulation. The U.S. tax system is progressive on income but relatively flat on investment returns, at least for long-term capital gains. If you're in the top 1% by income, your marginal federal tax rate might be 37% plus state and local taxes. You could be paying 45 to 50% on marginal income. But long-term capital gains are taxed at 20% federal, maybe 25% with state taxes. This creates a massive arbitrage opportunity that most high-income individuals fail to exploit. If you structure your wealth accumulation to generate long-term capital gains rather than ordinary income, you can nearly double your after-tax returns. Yet I see people taking high-income jobs with no equity component when they could take slightly lower-income jobs with substantial equity grants. They're optimizing for pre-tax income instead of after-tax wealth accumulation. It's mathematically irrational. Moreover, the estate tax exemption allows significant intergenerational wealth transfer. As of recent law, you can transfer approximately $13 million per individual without estate tax. For a couple, that's roughly $26 million. If you structure your wealth to remain below this threshold, you can pass it to the next generation tax-free, allowing compounding to continue across generations. Above this threshold, estate taxes can reach 40%, dramatically reducing the compounding base for your heirs. I'm not suggesting you make decisions purely for tax optimization. That leads to its own distortions. But understanding the tax implications of different wealth structures is essential. $1 million in a tax-deferred retirement account is not equivalent to $1 million in a taxable brokerage account, which is not equivalent to $1 million in real estate with depreciation benefits. They're different assets with different after-tax values, and you must think in after-tax terms. The fourth fatal error is failing to understand sequence of returns risk. This is subtle but critical, especially as you approach financial independence. When you're accumulating wealth, the sequence of returns doesn't matter much. If you invest consistently over 30 years, experiencing years of high returns and years of low returns, the order doesn't significantly affect your final wealth, assuming the average return is the same. But when you start withdrawing from your portfolio, sequence matters enormously. If you retire and immediately face a significant market decline, forcing you to sell assets at depressed prices to fund consumption, you permanently reduce your capital base. This is called sequence risk, and it's devastated countless people who reached the top 10 or 5% by net worth, but retired at the wrong moment in the market cycle. The solution is maintaining a substantial cash buffer. If you're approaching financial independence, you should hold 2 to 3 years of expenses in cash or cash equivalents. This allows you to ride out market downturns without forced asset sales. During the downturn, you spend from cash. When markets recover, you replenish the cash buffer from appreciated assets. This dramatically reduces sequence risk. But most people don't do this. They invest fully, maximizing expected returns, and then when markets decline, coincident with their retirement, they're forced to crystallize losses. I've seen people who accumulated $2 million, enough for financial independence at a 4% withdrawal rate, lose their independence because they retired in 2008 and were forced to sell into the decline. Had they held $200,000 in cash, they could have preserved their capital base and maintained independence. The opportunity cost of holding cash was far smaller than the cost of sequence risk. Let me now address geographic arbitrage, because this is one of the most powerful and underutilized tools for wealth accumulation. Income and wealth percentiles are national statistics, but the cost of living varies dramatically by location. In San Francisco or New York, $150,000 in income might be necessary just to maintain a middle-class lifestyle. In many smaller cities or rural areas, $150,000 enables an upper middle-class lifestyle with significant surplus for savings. If you optimize globally, earn income in high-wage markets, and consume in low-cost markets, you can dramatically accelerate wealth accumulation. This might mean working remotely from a low-cost area while earning a coastal salary. It might mean spending your career in a high-wage market but retiring to a low-cost market. The mathematics are compelling. If you can maintain a top quintile income while living in a bottom quintile cost area, your savings rate might reach 50 or 60%. At those rates, you can reach financial independence in 15 to 20 years, regardless of your starting point. I'm not suggesting everyone should move to the cheapest possible location. Quality of life matters. Access to opportunities matters. But most people don't even consider geographic arbitrage. They live where they grew up or where they went to school, and they accept whatever the local cost structure implies for their savings rate. This is leaving enormous value on the table. The fifth fatal error is conflating wealth with consumption. Our society constantly reinforces this error. We see expensive cars, large homes, luxury vacations, and we assume the people consuming these goods are wealthy. Sometimes they are. Often they're not. They're high-income individuals with low savings rates, accumulating debt or failing to build assets while funding consumption. True wealth is invisible. It's in brokerage accounts, retirement accounts, real estate, equity, business ownership. You can't see it driving down the street. The person driving a 10-year-old car might have $5 million in investments. The person driving a Range Rover might have negative net worth. External signals are not reliable indicators of wealth, yet people make decisions based on these signals constantly. I've always found this fascinating from a behavioral perspective. Humans are social primates. We evolved to signal status to our group. Consumption is a visible signal. Wealth is not. So people optimize for the signal rather than the substance. They buy goods that demonstrate high income rather than accumulating assets that generate lasting wealth. This is evolutionarily explicable but economically irrational. If you want to build wealth, you must become comfortable with the invisibility of wealth. You must stop seeking external validation through consumption. This is psychologically difficult, especially when you reach high income levels and your peer group is engaging in conspicuous consumption. But it's essential. Every dollar you spend on status signaling is a dollar that's not compounding. Over decades, the difference is exponential. Let me share a mental model I found useful. Think of your wealth as a machine that produces income. Every dollar you invest is adding to the machine's capacity. Every dollar you spend on consumption is foregoing a permanent increase in the machine's capacity. Early in wealth accumulation, your machine is small. It might produce a few $1,000s per year. But if you consistently add to it and allow it to compound, it eventually produces tens of thousands, then hundreds of thousands in annual income. At that point, you can fund consumption from the machine's output without ever touching the machine itself. This is financial independence, when your machine's output exceeds your consumption needs. Notice that this is a function of two variables: the size of your machine and the level of your consumption. Most people focus exclusively on building a bigger machine. Very few focus on reducing consumption. But the mathematics are symmetric. Reducing consumption by $20,000 has the same effect as increasing investment returns by $20,000. Both advance your independent state. Now, you might be thinking, what's the point of wealth if you never spend it? This is a reasonable question. The answer is that you should spend wealth, but you should spend from returns, not principal. If you build a machine that generates $100,000 per year, you can spend that $100,000 knowing the machine is intact and will produce another $100,000 next year. This is sustainable consumption. Spending principal to fund consumption above your return level is unsustainable. It's eating your seed corn. The people who successfully reach and maintain top percentile wealth understand this distinction. They think in terms of sustainable withdrawal rates. They know that you can typically withdraw 3 to 4% of a diversified portfolio indefinitely. They size their lifestyle to this constraint. They don't spend windfalls on one-time consumption. They add windfalls to the machine, increasing its capacity permanently. Let's talk about career decisions through this framework. Many people face choices between higher income paths with more risk or instability and lower income paths with more stability. The conventional advice is to maximize income, but the rational decision depends on your wealth level and your accumulation rate. If you're young with low net worth, taking career risk often makes sense. Your human capital is high, your financial capital is low, and you have time to recover from adverse outcomes. This is when you should consider entrepreneurship, commission-based work, or equity-heavy compensation. The expected value is often higher, and even if you fail, you can rebuild. But if you're older with significant accumulated wealth, the risk-return trade-off changes. You have more to lose and less time to recover. At this stage, stability often has more value than upside. Taking a job that pays $400,000 with stability might be superior to a job that pays $600,000 with high termination risk, because the incremental income doesn't meaningfully affect your wealth trajectory, but the stability protects what you've built. I see people making the opposite choices constantly. Young people taking stable, modest-paying jobs because they're afraid of risk, when they should be taking calculated risks. Older people with established wealth taking high variance positions for incremental income when they should be prioritizing capital preservation. These are optimization errors driven by misunderstanding the objective function at different life stages. There's also the question of when to transition from wealth accumulation to wealth preservation. This isn't a binary switch. It's a gradual shift in portfolio composition. When you're young, you should be heavily weighted toward growth assets, stocks, especially small cap and international, perhaps venture capital or private equity if you have access. Your human capital provides a bond-like base, so your financial capital can be aggressive. As you age and accumulate wealth, you gradually add stability: bonds, cash, perhaps annuities for longevity insurance. By the time you reach financial independence, Your portfolio should be balanced between growth and preservation, generating enough return to sustain consumption while protecting against major drawdowns. The specific allocation depends on your risk tolerance and spending needs, but the direction is universal. More risk early, less risk later. Most people don't make this transition deliberately. They maintain the same portfolio allocation for decades, either staying too conservative and sacrificing returns, or staying too aggressive and exposing themselves to unnecessary risk late in life. This is another optimization failure. Your portfolio should evolve as your circumstances change. Let me address one more critical concept: the difference between absolute and relative wealth. You might be in the top 10% nationally, but feel unsuccessful because you're comparing yourself to people in the top 1%. Or you might be in the top 1%, but feel unsuccessful because you're comparing yourself to billionaires. This is the hedonic treadmill applied to wealth. Here's the reality: there will always be someone wealthier. If you derive satisfaction from relative position, you'll never be satisfied. The person with 10 million looks at the person with 100 million. The person with 100 million looks at the person with 1 billion. This is a game you cannot win through accumulation alone. The solution is defining sufficiency. What level of wealth enables the life you want to live? Not the life society tells you to want, not the life your peer group is living, but the life that aligns with your values and goals. For some people, this might be $2 million. For others, it might be 20 million. There's no universal answer. But without defining it, you'll perpetually feel insufficient. I reached a point decades ago where additional wealth didn't materially change my life. I still worked because I found the intellectual challenge rewarding, not because I needed the money. This is the paradox of wealth. The people who accumulate the most are often those who are intrinsically motivated by the work itself, not by the financial rewards. They optimize for interesting problems, and wealth is a byproduct. If you're chasing wealth purely for its own sake, you'll likely fail. The path to significant wealth requires sustained effort over decades. That's only possible if you find the work itself rewarding. If you're grinding through a job you hate to reach some wealth threshold, you'll probably burn out before you get there, or you'll reach the threshold and realize it doesn't provide what you thought it would. So here's my final synthesis. Being in the top 10% by income means earning approximately $173,000. Being in the top 10% by net worth means having approximately $1.3 million. These are different achievements with different implications. Income can be transitory. Net worth, if properly managed, compounds forever. The top 5% thresholds are roughly $250,000 in income and $2.6 million in net worth. The top 1% thresholds are roughly $570,000 in income and $11 million in net worth. But these numbers are less important than the principles that determine whether you move through these percentiles or stagnate. Save a high percentage of your income, regardless of how much you earn. Invest for risk-adjusted returns over long periods, not short-term gains. Diversify against your human capital, not with it. Maintain low fixed costs relative to your liquid net worth. Think in terms of after-tax wealth accumulation, not pre-tax income. Understand sequence risk as you approach financial independence. Consider geographic arbitrage. Resist conspicuous consumption. Define sufficiency, and stop chasing relative position. These principles are mathematically sound. They're also psychologically difficult because they require resisting social pressure, delaying gratification, and thinking probabilistically in a world that rewards narrative and emotion. But if you can internalize these principles, if you can think like a quantitative investor about your own finances, you'll compound wealth steadily over decades. You'll move through percentiles, not through luck or windfalls, but through systematic advantage. The people who reach and maintain top percentile wealth aren't lucky. They're not necessarily smarter. They've simply internalized principles that align with mathematical reality. They've optimized for the right variables. They've avoided the fatal errors that trap most high-income individuals in cycles of consumption and financial fragility. Now, I want to ask you something. If you found value in this framework, click the like button below. More importantly, Leave a comment telling me one specific action you're going to take based on what you've learned. Will you calculate your actual percentile position? Will you restructure your portfolio to diversify against your human capital? Will you reduce fixed costs to increase your runway? Write it down. Make it concrete. Thinking is useful, but action is what compounds. Wealth is not mysterious. It's not